Welcome to the Power and Market Report on the Sprott Media Network. I'm your host, Albert Liu, and I've got a great show for you today. Coming back on the program is James Rickards. He's the best-selling New York Times best-selling author and chief global strategist for Meriglim Inc. You can find out about them at meriglim.com. James, welcome back to the Power and Market Report. How are you?
I'm fine, Albert. Thank you. It's great to be with you.
Among your many accomplishments, I could have also added probably the most pirated interview on YouTube, James. I was boning up on what you've been up to, searching some of your interviews, and I came across one that sounded very familiar. Turned out it was one that I did with you. So
okay.
You're on fire. You're all over the place. First, before we start, though, I want to let the viewers know that on April 5th is the first anniversary of the new case for gold, so congratulations on that. And on April 7th, you're releasing the paperback edition of The Death of Money. So again, congratulations.
Thank you. And that paperback edition, The Death of Money, as you know, Albert, New York Times bestseller, came out in 2014. A couple of things. You're right. The paperback edition is coming out in a couple of days. It's unusual. Usually a publisher will go to a paperback within about a year of the publication of the hardcover, but the hardcover, I'm happy to say, sold so well for so long that they delayed the paperback edition. But now the paperback edition is coming out. It has new material in it, so it's not just a soft cover of the old book. It actually has some a new preface I wrote that kind of goes over the material, shows why it has played out the way we expect it, and also adds entirely new material, including new disclosures never before published on insider trading ahead of the 9/11 attacks. So very excited about this. It's almost, it's like it's a very timely book, still timely after a few years, but with some very new material included.
And congratulations on that, James. I was going to joke at the beginning of the show that it's been 3 months since we last talked, and where's the new book? It turns out there actually is a new book, so right. Congratulations on that. I also want to tell the viewers that on April 4th, you and I are going to be participating in a webcast with Rick Rule and Trey Reich, and the topic is Will Gold Trump Politics in 2017? I can't think of anyone else I'd rather talk about this with than the three of you. I'll be moderating the discussion. If you want to register and you're watching, go to sprottusa.com, and there's a banner ad there where you can register for that event. That's April 4th. And finally, I'm also very happy to announce that, James, you're coming back to our conference in Vancouver once again this year. You've been extremely popular the last two times you came to speak. And so that's July 25th this year in Vancouver. It's the Vancouver Natural Resource Symposium, put on by Sprott. And if you want to go to that event, you can find out about it at naturalresourcesymposium.com. The price is discounted now and is going to be going up quite significantly. Also, if you sign up now, you can get the MP3 files from last year's event. You can hear James's spectacular talk from last year. So that is all the news. Looking very forward to that. James, we have some things to talk about. Let's start with the Fed. They seem to be following through on some of these rate hikes. Vice Chair Stanley Fischer says he sees 2 more hikes coming in 2017. Do we believe him? And should we care either way?
Yes and yes. We should believe him and we should care. Albert, going back to last December, of course, December 2016, the Fed raised rates. And then immediately after that, based on my analysis, and I'll explain the model I use because it's fairly straightforward. I said the Fed would raise rates again in March 15, 2017. I said that in December. I said it in January. I said it in February. What was amazing to me, we have these Fed fund futures contracts, and you can look at the price of the Fed fund futures and do get the market probability, what probability the market is assigning to another rate hike by the Fed. And if you follow the wisdom of crowds and so forth, you would say, well, this is all the money in the world, all the interested parties in the world coming together in one very liquid marketplace, setting a probability. And then in December, they gave it a 28% probability. That's the March rate hike. 28% probability. Throughout January, it was 30%. February was 30%. The whole time, I was kind of 75, 80%. I was, quite certain they would raise rates. You never want to say 100%. That's silly, but I was kind of, 80% converging on 100%. Then suddenly, in 3 trading days, right around the end of February, early March, so kind of February 27th, 28th, March 1st, March 2nd, the probability went from 30% to 80%. It was caught up to where I was all along. It was one of those hockey stick charts where it's flat and then it just sort of goes vertical. And then, of course, by March 15th, all of us converged on 100%. It was very clear that the Fed was going to raise rates by that point. But I was just kind of amazed. It was very clear to me in December that they were going to do it. The market stayed at 30%. Why is that? Why did and just because markets are collective wisdom and they're liquid doesn't mean they always get it right. And sometimes they have these catch-ups. And the reason is that the market, believe it or not, actually doesn't understand why the Fed is raising rates. And let me just and I realize that's a major statement. Let me just take a minute to unpack that a little bit. Here's my analysis. The economy is fundamentally weak. The Fed is raising rates into weakness. By the way, I expect they'll raise again in June. So here we are in late March, coming up in April. I'll just say that as of now, my expectation is they're going to raise again in June. That is what Vice Chairman Stanley Fischer suggested yesterday. But they're not raising them because the economy is strong. Actually, the economy is fairly weak. They're raising them for a completely different reason. This rate hike cycle that the Fed is in is detached from the business cycle. Normally, the way it works is that the economy gets stronger, labor markets tighten, unemployment goes down, inflation picks up, and the Fed's watching the whole time. And they say, you know what, we better do so. We better raise rates. Then they raise rates, they raise rates, they raise rates. Sure enough, the economy cools down, unemployment goes up, inflation comes down. We get close to a recession. Maybe we're in a recession, and the Fed's watching again. The Fed says, oh, we better cut rates, and so forth. So you have this nice kind of sine wave, this cycle. But what's important about that is the Fed does not lead the economy. The Fed follows the economy. So as the economy is going up, the Fed's watching, and then they tighten. And as the economy cools down, the Fed watches, and then they ease. So the Fed follows the economy through the business cycle. And that's what the market is saying. But that is not what's going on right now. What's going on is the Fed is trying to raise rates, even though the economy is weak, because they're trying to raise them to get them high enough so they can cut them in the next recession, which could be coming very, very soon. I mean, we're 8 years into an expansion. This is extraordinarily long. This is long by post-1980 standards, which is an era of long expansions. It's double the average expansion since the end of World War II. This is an extremely long expansion. It's been a weak one of the weakest expansions in U.S. history, but a very, very long one. So no one should be surprised if we have a recession tomorrow. I'm not forecasting that. I'm just saying that we're at a stage where that could easily happen. The Fed knows this. Now, the data shows that you have to cut interest rates 3 or 4%. Full percentage points, 300 basis points, in other words, or more, to get the U.S. out of a recession. How do you cut interest rates 3% when you're only at 1/2 of 1%? The answer is you can't. You've got to, and by the way, the evidence is that negative rates don't work. Negative rates are not more of the same, like more cutting. When you go from 0 to -25 to -50, technically you're cutting rates, but that does not have the same effect as cutting positive nominal rates. So that doesn't work. So the Fed is desperately trying to get the rates up so that when the recession hits, they can cut them again to get us out of the recession. The problem, the finesse is, can you raise rates in a weak economy without causing the recession you're trying to cure or getting ready to cure? My view is they're not going to be able to pull that off. Why is the Fed in this situation? Well, the reason is they missed an entire tightening cycle. The time to raise rates was 2010, 2011, 2012. In the early stages of the recovery, that's when you raise interest rates. The Fed didn't. They skipped a whole cycle because of Ben Bernanke's crazy experiment with zero interest rate policy and QE1, QE2, QE3. I mean, I think the viewers are very familiar with all that. We don't have to revisit all that. We'll look back, and this will be viewed as a major failed monetary experiment where we're all the guinea pigs. But they skipped a cycle. So now they're playing catch up. So they're raising rates at the worst possible time, because they're trying to catch up, get them high enough so they can cut them when the next recession comes, and do that without causing the recession, which they probably will. Now, the market doesn't see what I just explained. What the market's saying is they associate, they do all these correlations and regressions. This is just Wall Street, typical Wall Street research. So they see a correlation between raising rates and a stronger economy. Well, that's true. There is a correlation between raising rates and a stronger economy historically. It just doesn't apply now, because we're guinea pigs in this experiment that I just described. So what's going on now is completely different than what Wall Street understands. All this happy talk of, the Fed's raising rates, so the economy must be strong. No, it's completely backwards. First of all, raising rates doesn't make the economy strong. It's the other way around. A strong economy causes the Fed to raise rates. But that doesn't even apply now because, as I say, they're playing catch up. So, and this will persist. Now, the way you can understand this, the Fed will raise rates 4 times a year, every other meeting for the next 3 years into 2019, until they get them up to 3.5%, 4%. Unless, and this is important, one of 3 things causes them to pause. There are 3 things that would cause the Fed not to raise rates. One is a major market meltdown. I mean 10% or more. In other words, a full-blown correction. 5% won't do it. So if the Dow goes down 1,000 points, the S&P goes down 100 points, that will not throw the Fed off this course. That will not throw them off their game. It's got to be double that, on its way to 15%, and then in which case the Fed would pause. The second one is if you see job creation fall, below 75,000 a month, a very low threshold, by the way. I mean, recently, monthly job creation, the most recent report was over 200,000. It was very strong. But even if you saw it at 125,000 or 100,000, that's not enough. It's got to be 75,000 or less, or certainly if we lose jobs. And the third thing is disinflation. The Fed has this target of they want 2%. They use PCE deflator core. So year-over-year PCE deflator core. They want that to be 2%. If you see that going backwards, it has been going up a little bit lately, but if you see it going down to 1.4, 1.2 or less, that will throw the Fed off the game. But those are the only 3 things. So job creation dries up, disinflation, or some kind of market panic either here or abroad. If you see those 3 things, the Fed will pause. If you don't see them, they're going to raise rates. So this is a very easy forecast to make. It wouldn't surprise me, absent those factors, for them to raise 3 more times, March, September, December. Now, I don't think they actually will. And the reason is that the first reason I mentioned, which is, in the course of raising rates, they're going to stall the economy, and then you'll see either the disinflation or the market crash that will cause them to pause. But we're not there yet. This won't really sink in until the summer.
You just blew through my next 3 or 4 questions, so you're a mind reader as well, James. But of the 3 things you mentioned, to me it seems that the severe market correction is the scariest to them, and obviously the disinflation is also scary because it could cause a meltdown in asset prices. I don't see them getting through 2018 without causing something like this. And then I understand what you're saying about the 10% threshold, but I think if the market goes down 5% and the Fed doesn't flinch, it's going down 10 or maybe even more. What are your thoughts on that?
Well, if it does go down 10, they'll pause. But if it goes down 5, they won't. By the way, I talked to Ben Bernanke about this when I caught up with him in Korea. What he said was the Fed doesn't care unless the market goes down 15%. At 15%, which would be that would be 3,000 Dow points. So it drops from roughly 20,500 to 17,500, back where it was before the election, giving up all of the Trump rally, all of the Trump reflation trade, and very quickly, meaning in a matter of weeks, the kind of thing we saw in August of 2015, or the kind of thing we saw in January of 2016, where it actually gets scary looking. Those kinds of corrections would cause the Fed to pause. They definitely would not raise rates in that situation. But 5%, they literally don't care. Now your point, Albert, well, gee, if it's 5 or 6 or 7, aren't you on your way to 10? You might be. It depends on the momentum, whether it's kind of – see, right now it's kind of like stalling, a little slow grind down. This isn't a crash. This is just grinding down. That's not going to upset the Fed that much. They would say it's not their job to prop up stock prices, even though they have, in fact, done that because of the so-called wealth effect. But if it goes down precipitously, you see 1 or 2 percentage points a day, day after day. So it's 2 weeks go by and we're down 10%. Yeah, that would cause the Fed to pause, and that's obviously very very dangerous because of the instability of the system as a whole. Now, on that point, I'll be brief. I separate the business cycle, the kind of crash you might get in a business cycle or recession, from a systemic crisis. Both of those things can cause the market to go down, but it goes down for different reasons. In a normal business cycle, the stock market's supposed to go down because earnings are going to dry up and multiples are going to contract and people are going to sell stocks, and it might get a little bit disorderly and you might see a 10% correction. That can be associated with a normal business cycle. But you can also see the market crash for systemic risk reasons. This would be some kind of shock, the kind of thing we saw in 1998 with Russia, the kind of thing we saw in 2008 with, Bear Stearns, Fannie Mae, Freddie Mac, Lehman Brothers, all in pretty close sequence. The two things can go together. You can have a business cycle correction without a panic. You can have a panic without a business cycle correction. We had that in October 1987. October 19th, 1987, the stock market dropped 22% in one day. One day. That would be the equivalent of 4,000 Dow points or 450 S&P points in one day. But there was no recession in 1987. The market, it was a shock. A lot, some people went out of business, but the market kind of recovered. So panics and business cycles are separate phenomena, but they can go together, which they did in 2008 and also in 1929. So that's kind of the worst of all possible outcomes.
I agree. James, I was going to joke and ask you what you were doing in North Korea, but I think that would get me in trouble with people who don't have a sense of humor. I'm not calling Bernanke a communist. It's a joke.
We were close to. We were in South Korea, but we were close to North Korea, not far from the border.
Okay. I think you're right. The fact that if the panic and the business cycle, the bust, coincide, you could have something very violent. And I think that's what we may be looking at this time, simply because the panic will come from the fact that we've ignored the business cycle for so long. Like you said, we skipped an entire cycle, just acting as if it didn't exist, keeping rates pegged to zero. So what probability would you put on that? The big business cycle correlated with or corresponding with just a massive panic like we saw in the 80s?
I agree with that, and I think it'll actually be a lot worse than certainly what we saw in 2008. It'll actually be, to me, this is more of an extinction level event as these things go, as economic crises go. And pardon me, but the reason I think the business cycle will fall out of bed along with a systemic risk is because the Fed has smothered the business cycle with zero interest rate policy, money printing, expanding the balance sheet, forward guidance, all these manipulations. We didn't have a real low in 2008. What I mean by that is, you hear a lot about the V-shaped recovery. So the economy goes down very sharply, and then it goes up very sharply. That's a normal kind of phenomena in a business cycle. It's what happened in, pardon me, in 1981. It's what happened in 1974. It didn't happen this time. What happened is we started to go down sharply, but the process, the process was truncated because of Fed intervention, not just money printing, QE1 and zero interest rates, but tens of trillions of dollars of swaps with the European Central Bank, where Europe was desperate for dollars. The European Central Bank can't print dollars. They can only print euros. So we printed up a bunch of dollars. They printed up a bunch of euros. We swapped them, again, to the tune of tens of trillions of dollars in euro swap. We didn't know that at the time. It was suspected, but it was years later because of Dodd-Frank and some congressional hearings that information came out. But what we did know at the time, they guaranteed every bank deposit in America. They guaranteed every money market fund in America. They didn't have to. I mean, we had FDIC insurance up to a limit. There was no guarantee on money market funds, but the Fed went in and guaranteed them. So they took these extraordinary actions. They did truncate the collapse, but you never got it out of the system. We never had the write-offs, the bad debts, the closures, the things that should have happened to get the to basically get the system to a point where it was able to grow much more rapidly above trend on a sustainable basis and get back to trend. What we've had instead is below trend growth for 8 years. The U.S. is Japan. I said this in my first book, Currency Wars, in 2011. I actually said it before that Bernanke spent the early part of the 2000s, the early 2000s, just excoriating Japan. He says, Japan, you don't know how to run monetary policy. You don't know how to get out of a recession. People talked about the lost decade. Then it was the lost 2 decades because, this started in 1990. So by 2010, you had 2 lost decades. Now we're more than halfway through a 3rd lost decade. It's been 27 years of on and off recession, depression, deflation, disinflation in Japan. Nothing like trend growth. And Bernanke criticized them, and yet he made every mistake the Japanese made. We are Japan. The U.S., our best case is 2% as far as the eye can see, which will cause the country to go bankrupt because our debt is growing at 3.5% a year for now, and it's going to grow at 4% or more beginning in a couple of years. Our debt to GDP ratio is at an all-time high when you count contingent liabilities, but even just the actual debt is 105%, which is approaching the levels not seen since the end of World War II. We're on the path to Greece. When you grow your economy at 2% and you grow your debt at 3 and 4%, you're going broke. You may be going broke slowly, but that's a recipe for eventual insolvency. And the only way out of that is actual default or very powerful inflation, which they haven't been able to get. So you have all these disaster scenarios in the making. But meanwhile, as I say, it looks like the business cycle will wind down because it's been going on so long, combined with the systemic risk we're talking about, but on a bigger scale because the banks are bigger, the balance sheets are bigger, the derivatives books are bigger, and one of the key lessons or key teachings of complexity theory, which is the best way to understand the economy, is that risk is an exponential function of scale. What that means is that when you double or triple the system, you don't double or triple the risk, you increase it by a factor of 10 or more. And so we have increased the system, and we've increased the risk even more, which is why I say the next crisis, and by the way, the central banks can't bail it out because they haven't normalized from the last crisis. So this is an extinction level event.
Let's talk about the Federal Reserve and the governors. James, in a previous conversation, you talked to me and related a story that a speechwriter had presented. I think it was Bernanke at one point, 2 speeches, one dovish, one hawkish, and Bernanke didn't know which was which. These guys are all coming out this week on the calendar speaking. It's some of them more than once. Like, what are they trying to achieve by talking to the markets directly?
Well, a couple of things. The story you're referring to, Albert, and I do include this in my last book, The Road to Ruin. So this anecdote is in there in chapter 6. It wasn't, pardon me, it wasn't exactly a speechwriter. It was basically the guy who's in charge of communications policy. But when I say communications policy, I'm not talking about speeches and public relations so much as the actual writing of these releases that come out at the end of the each FOMC meeting. They have a press release, but it would also include, you're right, include some of the content of some of the speeches. Had the office across the hall at the Federal Reserve Board in Washington from Ben Bernanke, and later Janet Yellen, worked with both chairs, very close to both of them. And the story was they were getting ready to issue a release, and they were both one was slightly more hawkish than the other. But the point is, they do this wordsmithing, and Bernanke looked at the 2 drafts and he said, which one's the bad one, was the question. Which one's the bad one? Which shows how arbitrary the words are, and what they really do, they call up the Wall Street Journal and leak their message, and then the Wall Street Journal regurgitates it, and everyone goes, "Oh, now we know what it means." But it's really just wordsmithing and leaks, and that's how they operate. That's how they operate forward guidance. But as far as these speeches is concerned, one thing that can save people a lot of time. There are 7 members of the Board of Governors. I should say there are 7 seats. Right now, 2 of them are vacant. There'll be 1 more vacancy next month. So there are really only 5 members of the Board of Governors today, soon to be 4. There are 12 regional reserve bank presidents. So right now you have a total of 17 Fed heads, if you want to think of it that way, either governors or regional reserve bank presidents. There are only 4 you need to listen to. You can completely disregard the rest. I'm not saying, they're nice people. They're smart people. That if you're a real geek and you want to read the speeches, that's fine, but it has no impact on policy is what I'm saying. The only four you have to pay attention to: Janet Yellen, Stan Fisher, William Dudley, president of the Federal Reserve Bank of New York, and he's the only Reserve Bank president who counts. And I would say to a lesser extent, but still important, Lael Brainerd. Lael's a member of the Board of Governors. She's the expert on international contagion, international spillover. She was the one who in late February, sorry, mid-February 2016, basically persuaded the Fed to switch from tightening to ease, go dovish, in other words. She was also very influential in September of 2015 to get the Fed to push back the liftoff. Remember the famous liftoff when they were going to raise rates? It was all teed up for September 2015, but you had that meltdown in the Chinese stock market and then the U.S. stock market in August 2015. And she was influential in saying, you know, don't raise rates now. And they did push it back to December 2015 for the first rate hike. That was the liftoff. So I pay attention to Yellen, Fisher, Dudley, and Brainerd. Everybody else you can completely ignore. Now, having said that, pardon me, this is all about to change radically because of President Trump. And Donald Trump owns the Fed right now. He owns the Fed. And let me explain why that's true. Because there are the two vacancies I mentioned. Well, a third governor, Dan Tarullo, just announced his resignation effective in April. So count that as a third seat. So he'll have three vacancies soon. You have Jay Powell, who's on the board today. He's a Republican. He's the only Republican. He hasn't had anyone in his sandbox for a long time, but he'll soon have three Trump appointees. So you're going to have four kind of Republican appointees probably in a matter of weeks. Beyond that, Janet Yellen's term ends on January 31st, 2018, but that requires Senate confirmation, so they're going to have to name her replacement before then, so the Senate can schedule confirmation hearings. So Trump will probably make that appointment maybe as early as November or December, which is not that far away. That's just another 6 months away. So there's five. And then Stan Fisher's term ends in June 2018. Same thing. They're going to have to announce that probably by April or May. So within a year, just over a year from where we are now, Trump is going to have five new appointments and one Republican on the board. He's going to control 6 of the 7 members of the Board of Governors. The only Democrat, Lael Brainerd will be the only Democrat. She might resign just because she won't have any friends. She'll be like Jay Powell is today. She won't have anyone to talk to. No president has had this many appointments at one time since Woodrow Wilson, 1913. That was only because all the seats were vacant, other than there were 2 statutory seats at the time, the Treasury and the control of the currency. But other than that, Wilson got to fill all of those seats in 1914 because they were all vacant. So Trump owns the Fed for the reason I just described. So that's easy. Now the question is, what does Trump want? Because Trump's going to get whatever he wants through the appointments process. The question is, what does he want? He's really flipped around on, all during the campaign, he complained that China was cheapening its currency, and then more recently he complained that Germany was cheapening its currency. I mean, Germany doesn't have a currency. They have the euro, but that's not run out of Germany. It's run by the European Central Bank. Same thing with Japan. So he's pointing a lot of fingers, but he hasn't actually done anything about that. He said he would name China currency manipulator, has not done that. He's done a lot of what he said, but that's not one of them. So you think that Trump's a weak dollar guy based on that, and yet you look at the people around him, David Malpass, Steve Moore, Larry Kudlow, Art Laffer, Judy Shelton, others. These are all strong dollars, sound money people, and some of them are explicitly pro-gold. So I'm not saying Trump's going to go to a gold standard anytime soon. I'm just saying that I expect Trump to appoint hard money people. I think we're going to see a big bang kind of announcement where he announces 3 seats all at once, including a vice chairman for regulatory matters. And I think you'll see that they're hard money people. And again, I don't know this for a fact, but there's very good reason to believe, based on some conversations going on behind the scenes involving the White House, that they want to put Kevin Warsh on the board, and that he would actually be the next chairman of the Fed. He would replace Janet Yellen. Now, what's interesting about that, Kevin Warsh was already on the Fed. He was a governor. He's not the chairman back in 2010, and then he resigned. A lot of these guys, they don't fill out. These are 14-year terms. No one stays around for 14 years. Some of them, they leave at some point. So Kevin Warsh has no reason to go back on the board unless he's going to be chairman, because he was already on the board. So if you see Kevin Warsh go on the board, that's a signal that he is going to be the next chairman, because otherwise he wouldn't take the job. So you could make Janet Yellen a lame duck by next month. Can you imagine being chairman of a board and there's the next chairman sitting right next to you, and everyone in the world knows it? It's kind of embarrassing, but as I say, it's a way to pull the rug out from under Janet Yellen. So I described why the Fed's on a tightening path, having to do with catch-up, trying to raise rates before the next recession. But I don't see that changing. If anything, the people I'm talking about, the Judy Sheltons and Kevin Warshes of the world, let's see who they actually are. But if they're hard money people, if they're Taylor rule people, the Taylor rule would say that rates should be 2.5% today. So I expect this hard money path to continue. What that means is it's going to slow down the U.S. economy, because the economy is already weak, and then we could be in a recession by the summer. So it's kind of fasten your seatbelts in terms of what that means for the stock market.
Kevin Warsh, just like Richard Fisher, has been quite outspoken since he left. I think it would be an interesting confirmation. But you just turned everything upside down on me. So I was thinking that with Trump in controlling 5 out of 7, we would expect a weak dollar. Also, I would have guessed that there would be QE4 eventually, and it would go into infrastructure and building, because he's a builder, not a banker. We're running out of time, but just your quick comments of that. You're thinking strong dollar, not weak dollar with Trump?
Well, for the time being, yeah. Now, because Trump wants to do something about the trade deficit, that's for sure, but they're not going to do it through the currency. They're going to do it through trade policy, through tariffs. So the attack on China is not going to run through the Federal Reserve Board in a weak dollar. It's going to run through Wilbur Ross, Peter Navarro, Dan D'Amico, Robert Lighthizer, who's the designated United States trade representative. That's where they're going to get China with tariffs and other non-tariff barriers, more so than the currency wars.
Okay, very good, James. I've kept you over, so thank you very much. Just want to remind everyone, April 4th, webcast Will Gold, Trump Politics in 2017. Check out that. Join me, James Rickards, Rick Rule, and Trey Reich. Go to sprottusa.com for details. April 7th is the release of the paperback edition of The Death of Money with a brand new preface. And then later on, July 25th, the Vancouver Natural Resource Symposium. You can check out that at naturalresourcesymposium.com. Go now, get a discount. Also get the MP3 files with James's presentation from last year. James, it's always a pleasure to speak with you. Thank you very much, and I look forward to doing it again.
Thanks, Albert. And just that Death of Money paperback, that's available for pre-sale on Amazon right now. So I hope the viewers have a look. And as I say, there's interesting new material in the preface.
Don't wait. Get it now. Thank you very much, James. Take care.
Thanks, Albert.